Hey, what's up guys? Brad here. So today I want to talk about something that's very confusing for a lot of people. I want to talk about the difference between mutual funds, index funds, and ETFs. And by the end of this video, I want you to have the information you need to make the most profitable choices if you decide to invest in these kinds of funds. So let's get into what they are first. So mutual funds are investments that pool your money together with other investors to purchase shares of a collection of stocks, bonds, or other securities that might be difficult to recreate on your own. So you get an advantage with economy of scale. For example, shares of Berkshire stock right now, Berkshire Hathaway, are hundreds of thousands of dollars. So you wouldn't be able to do that on your own, at least back when people were, back when these mutual funds were getting started. There are actually vehicles now that would allow you to do that through fractional shares. But, this was the whole idea with mutual funds. You're pooling money together. You've got a portfolio manager who manages that money, who actively selects which investments are in the fund. And you get that advantage. So some of the advantages, you got the economy of scale. You can buy things that are more expensive on a per share basis than what you would be able to invest in. You've got diversification. A lot of mutual funds have 50, 100, more than 100 different securities in the fund. Whether that's beneficial or not is up to you. I have my own views about diversification. Obviously, if something goes to zero and you have a lot of securities in the portfolio, that thing doesn't impact the portfolio much. But that's the same if something goes really high. You've got all of these other securities that are diluting the effect of that great investment. So diversification works both ways. You've got liquidity, which means you can get in and out of a mutual fund when you want to. Whereas, say, if you own a house, you can't just sell the house whenever you want to. There's a process. There might not be demand for it. So this addresses some of the liquidity issues with different types of securities by having a fund, shares in a fund that you can buy and sell. And then, of course, you have professional management. Now, the con of a mutual fund, the downside, is you have professional management, and them and their staff takes money. So there tend to be high fees associated with mutual funds, maybe 1% to 2% per year. That's fixed. So you're losing 1% to 2% of your portfolio balance every year, regardless of whether or not the account is going up, or even if it's going down, you're still going to pay this 1% to 2% fixed fee. And then, I've also seen with mutual funds, there's often an account minimum. So you have to invest at least, say, $2,000 or $5,000 to get into that fund, okay? So that's kind of an overview of mutual funds. Let's talk about index funds. So index funds are actually a type of mutual fund, a subset of mutual funds, where the portfolio is constructed to match or track the components of a financial market index. So the S&P 500 is one such index. There are rules for what it takes to get into the S&P 500 index. Typically the company has to be, I think it's larger than 5 billion in market cap. They've got to have a certain amount of liquidity. There's a couple different guidelines for what it takes. So you've basically got the largest U.S. companies, the 500 largest U.S. companies in the S&P 500. So you can have an index fund where the portfolio consists of all of those same companies that are in the S&P 500 index. So you've got the diversification in an index fund. You've got liquidity. You can get in and get out. And you have low fees. So it's got a lot of the advantages of a mutual fund. Of course, it's a subset of mutual funds. but it has lower fees. And what Warren Buffett really figured out is that, and what he recommends to people, if you don't know enough to pick individual stocks, you're better off buying an index fund that tracks an index than you are getting into a mutual fund where you have active management that charge much higher fees, because those fees really eat in to your gains over time. They really kind of knock back the ability of your portfolio to compound over time, okay? So the fees are huge. It's a huge consideration. And the passive index funds, which, index is more of a passive approach than the active management of a lot of mutual funds. The passive nature of it means it costs a lot less. You don't have professionals who are picking individual companies. If a new company enters the S&P 500 index and one gets kicked out, that just gets adjusted automatically in an index fund. So there's no stock picking, there's no market timing, there's no professional manager kind of waiting for a stock to get to an attractive price before buying that stock. It's automatic. When money enters the index fund, the things are added proportionally as they are in the index. There's no thinking about it. And there's an index fund for virtually every financial market in existence. Okay, so you've got the S&P 500. There's the Russell 2000, which is made up of small cap company stocks. You've got the Wilshire 5000 total market index, the MSCI foreign stock index, where they track certain companies in certain international markets, the Dow Jones Industrial Average, which is 30 large cap companies. So you've got all kinds of indexes to be tracked, and there are funds for every different kind of index. It's not just the S&P 500. So a lot of variety there, which also incorporates another challenge for us as investors. Index investing, people think of as passive, but there are actually a lot of options to choose from. What index do you want to track? There's different types of indexes, and I'll talk about that right now. There's market cap weighted indexes, which is the S&P 500. So the S&P 500, the biggest company, you're going to have Apple. Amazon has been up there as well. But the biggest companies are going to make up the biggest percentage of the portfolio in an S&P 500 index. So that would be a market cap weighted index, where the bigger companies make up a bigger share of the portfolio. You can also have equal weighted indexes. So say you had an S&P 500 equal weighted index, you would have those 500 stocks, but you would have the same amount of them. So they would each make up 1/500th of the portfolio. So that's an equal weighted index. There are also value weighted indexes. And the way you might do that is look at the price to earnings ratio of each company. And the companies that had lower price to earnings ratios would make up a larger percentage of the portfolio. So that would be a value weighted index. So that's kind of an overview of index funds. Now let's talk about exchange traded funds, or ETFs. So an ETF is an investment fund traded on stock exchanges, okay, much like stocks. So you think, okay, what's the difference between that and an index fund? Well, typically index funds can only be bought and sold once each day, okay? Now ETFs can be traded whenever the market is open. So you could buy an ETF and sell it a minute later and capture that gain or loss. So it's more of a trading vehicle. Although as more and more people are getting on platforms like Robinhood, I don't think you can buy traditional index funds on Robinhood, because Robinhood is really designed as a trading platform. But you can buy the ETF VOO, which is essentially the Vanguard S&P 500 index fund, but it's in the form of an ETF, okay? And it also has very low fees. It has 0.04%, which is the fee on that particular ETF, which I believe is the same as an index fund. That's the same thing, okay? So it's pretty cool. You know, we're in the age of technology where, you know, costs are really coming down on Robinhood. You can buy and sell without any trading commissions. Now you can get these index funds in the form of ETFs with as low of fees as the original index funds. So there's a lot of versatility coming online as technology really starts to take off. So that's the difference. Historically, the difference between ETFs is you can buy and sell as many times as you want. There's no limitation on how often they can be bought and sold. But now you've got ETFs with the same low fees as index funds. So, you know, the difference is kind of getting more and more murky. ETFs have been available in the U.S. since 1993, so for 27 years now. They were mainly index funds until 2008 when the SEC began to authorize the creation of actively managed ETFs. Okay, so now you can buy an ETF that's, you know, made up of a pool of, say, companies that mine lithium. Say, you know, you think the electric vehicle market is just going to take off. The, you know, lithium batteries are going to have higher and higher demand, and you want to invest in that segment, lithium batteries. There's an ETF for that. Or say you want to invest in cryptocurrencies, you know, but you don't want to set up an account. You don't want to kind of manage it in a separate account, you know, through Coinbase or wherever you get your cryptocurrencies. You can invest in an ETF where that ETF is focused on owning companies that specialize in cryptocurrencies. So, you know, ETFs allow you different options for investing in kind of different plays, whether you want to play on crypto, electric vehicles, lithium-ion batteries. There's so many different ETFs to kind of pick whatever trend you want to ride and get in. And then a few different, there's something I want to mention. I'm going to link in the description to a back testing tool that I use. And essentially what you can do is you can enter a ticker symbol. You can enter the ticker for VOO, which is the ETF S&P 500 index. And you can see how it's performed over time to compare different index funds and ETFs, compare the performance of different index funds and ETFs. And this is especially true if you're looking at some of these equal weighted or value weighted indexes where, you know, you're like, well, how have they done over time? You can plug them into this back testing tool and compare them. And you want to make sure you're comparing equal years. So some of them, the VOO, I think, was started in 2010. So you're only going to have back testing data for the last 10 years. So if you're going to compare that, actually, I don't like looking at anything that doesn't have at least 15 years of data. So it's just a way to compare one index to another index to see what the relative performances have been for the same time period. So I'll link to that. And I do like VOO. I think it's, you know, it's a very low cost way to index the S&P 500. But honestly, I'm really curious about value weighted indexes. I don't have a lot of experience with them. You know, one thing you want to make sure is that they don't have much higher fees than some of the other cheap indexes. The fees are really important. But especially at a time like this when I think markets are still a little frothy, I'd be leaning more towards looking at value weighted indexes as opposed to market cap weighted indexes. Yeah, I think that's all I wanted to share, guys. Let me know if you have any questions about mutual funds, index funds, ETFs. Happy to answer those. And what index funds are you investing in? I'm really curious. Obviously, there's a ton of people in the S&P 500 index. You know, Michael Burry pointed out that he thinks there's a bubble in index funds because whenever you have money piling in to securities without regard to price, which is true in index funds, you know, people put money in and those companies are bought automatically regardless of what price they are. That's where you get the passive investing from. So, you know, I think whenever something is in bubble territory or when you have buying indiscriminate of price, you know, it could be worthwhile to look at kind of lesser traveled areas of the markets, whether that's foreign indexes or, like I said, value weighted indexes. All right, guys, that's all I got. Have a great day, and I'll see you in the next video.